Welcome one, welcome all to DeFi Crypto and Airdrops. I am Mike, aka Veteran Crypto, and this is Jake Call from Metrix Finance. How's it going, brother?
How's it going? It's going great, man. Good Friday as always.
Oh yeah. Sorry, I'm glad you messaged me. I got caught up in doing some stuff online, and I don't know what the hell happened with my totally lost track of time. So, all right, let's kick this thing off because I'm actually excited to learn this myself. But before we get cooking, let's do this real quick. Let's see. Let me share my screen, and I will show the socials real quick. So if you aren't watching on YouTube, I highly suggest that you come on over to DeFi Crypto and Airdrops on YouTube and follow us and join the chat because that's where I'm going to be monitoring as we do this. That's where I'm going to be monitoring. And if you have any questions about Metrix Finance and as Jake is going through it and showing us the functionality of it, that's going to be the place to ask your questions. So with that, let's go ahead and take that down. And I'm going to go ahead and switch it over to. Actually, you know what? Yeah, let's do this. I'll just take myself off of here and go ahead and share your screen, and I will throw that up.
All right, there we go.
All right. And you can go ahead and take it from here, brother.
I appreciate it, Mike, and thanks for the introduction. If you guys don't already know, I post YouTube content myself. YouTuber turned software founder turned. Not supposed to show this quite yet. Little sneak peek. But which I want to drop some alpha here. But yeah, I mean, my background's in YouTube. Since I was like a kid, ran YouTube channels, got into gaming, right, and then eventually got into meme coins because I liked that they paid a lot of money per view that you got on them. And then that spiraled to me investing in meme coins, which spiraled into me investing into DeFi and now becoming a more conservative investor, not just gambling away all my money. And also, in the midst of that, helping other people avoid the mistakes I made. I just made a recent YouTube video that, if you want to learn some alpha, definitely check it out. It's I lost $50,000 in crypto, learn from my mistakes. Learn from what I experienced. So that way you don't have to make the same things. And again, you're going to make the mistakes. That's completely fine. Try to minimize them by avoiding some of these things. But that made me want to launch my software because there's a big pain point in the market. Concentrated liquidity, I think we all know this, is one of the most profitable opportunities in DeFi. But there is no tool out there that went into the granular levels of data that we wanted to go into, basically. So we built it. And Metrix Finance actually started as a fork of a tool called Uniswap.fish. Now, Uniswap.fish was a open source funded tool from the Uniswap Foundation. So they funded it to this one guy that just built it out. And then after they stopped funding it, the guy stopped building it, obviously, and it just kind of sat there, outdated. And that's in the midst of Uniswap branching out from just like 3 to 4 networks to now supporting Base, supporting Blast, supporting all these different networks. So we took the open source tool in August of 2023, forked it, got a version live the following month, so in September. So we came up on 2 years being live for now. And ultimately, after the fork, we started implementing new functionality. We're like, well, we need this, we need that, right? And we started building out these little things. Fast forward a couple months, February of 2024, we launched our V2, which was Metrix Finance, because it was a different name before, rebranded it under its own kind of umbrella, named it Metrix Finance, launched V2, which was a super sleek interface. And it was completely custom coded from the ground up. So we scratched all the code from the original thing because it was just getting super messy, and it was also very outdated and just wasn't clean. There's a lot of bugs that we found in the original thing. But yeah, and then we built it from the ground up and similar functionality. And then we've innovated a lot of things over time, like completely new things. But that's where we got the initial idea from. So segueing into what I wasn't supposed to show you quite yet, the next kind of chapter of Metrix Finance, I'm glad I get to be here today, Mike, and share it with everybody here, because this is one of the first times I believe that I'm announcing this and actually showing a preview, is lending and borrowing. So we're planning on implementing lending and borrowing directly into Metrix Finance. Not just where you can see like what basically, lending pools there are and stuff like that, but to the point where you can actually go in and like simulate your lending and borrowing. And again, I don't really have a demo to show you quite yet because this screen recording right here is a 1 hour call that I just had with one of my developers yesterday, where we kind of dove into every single little detail of it. But then you'll also be able to track your lending and borrowing positions. So again, that's the next chapter. And then on top of that, we're doing a little bit of a refresh as well. So we launched our V3 July 1st. It was a very successful launch. Everybody enjoyed like kind of the revamp of everything, the introduction of new tools, introduction of new features and stuff like that. I would say what we're coming up with like later this month is kind of like V3.5, maybe 3.25.
What just real quick, what lending platforms are you going to start with?
Yeah, so we'll start with Aave and Compound, and then we
Okay.
will branch our way out over to Solana, and then we'll branch our way out to the smaller platforms on each individual network.
Man, you better get on some base.
Yeah, we'll be on base.
Yeah,
Moonwell.
yeah. Oh, yeah. No, definitely. Moonwell, Morpho, all those.
Yep. All of them are on the roadmap, man. But yeah, we want to get a demo out with Aave and Compound, the two top ones that are kind of the go-to, and then essentially our process with a lot of these things, especially when innovating. Since we build so fast, we don't really have time for UI UX designers to like individually like do it, go take that, pull the audience. It's just like it's not capital efficient, it's not time efficient. So we find the best ways to do things are release things in the manner that we would use them, in the manner that makes sense to us, release it to our subscribers and stuff like that. And they're like, oh my gosh, like this is great. Or they're like, oh my gosh, this sucks. And we're like, okay, well, why does it suck? And then they tell us why, and then we improve. So just rigorous feedback will happen within the first 2 weeks. We'll have forums live where you can submit feedback and stuff like that, see what exchanges you want and everything. And then from there, we'll start to build out like the better version of lending and borrowing, and then start to implement all the other exchanges, or not exchanges, the markets. So yeah, but I haven't had the chance, or I haven't really spoke on what exactly Metrix Finance does right now. I've just spoke on a lot of different things. We are a concentrated liquidity pool tool aimed with one mission in mind: to stop losing money on liquidity pools, basically. And ultimately, that could be in two different ways. We see two different types of users. Number one, the users that want to profit. And when I say profit, I mean $10,000 in, $13,000 out, right? Which means they don't really care about impermanent loss, divergence loss, whatever, right? They're yield farming, so they're just chasing the yield, looking for the income. So in that regard, we want to make sure they have
As long as you make more than you lose.
exactly. We want to make sure that they have the best data available at their fingertips, right? We want to make sure they have the most accurate data at their fingertips, and they can truly see if they are profiting. And then the other side of things are what we do at my coaching company, Builder Wealth, which is asset accumulation. And we focus on acquiring more assets, beating holding in the market and stuff like that. That's another user that we service. And either way, like you can be at a loss, but profiting versus hodl. We'd consider that a win for a lot of our users. You could be at a profit, but a loss versus hodl. We'd consider that a win for our other users. So there's two different metrics. We want to make sure that we just stop the loss of money, basically, on liquidity.
Well, real quick, kind of dig in, like dial in on that a little bit, because I think I understand it, but I want to make sure everyone else out there understands that kind of what each of those means. Like, because I know that one means that you're increasing your exposure to an asset because you're collecting more tokens, not necessarily profiting dollar wise, but the other one, like you said before, you're making money or making income. So dollar wise, you're making more than you're losing.
Yeah.
I mean, is that correct?
Yeah, so it's like a choose your goal, and we kind of spoke about this on the session the other day, basically, with me and David's both of our perspectives. And essentially, when we look at my portfolio right now, I just want to show you. So I have about 65 grand in these 4 different liquidity pools. We have $311 in earnings. Of that, 221 of that is a profit compared to holding the market. So what that tells me, Mike, is earnings aside, if I just stuck my money in these assets, I held them, the exact amount that I stuck in the liquidity pools, I would actually have not $64,931. I'd have $65,031 roughly, right? Because my impermanent loss is about $100 here. And we'll dive into how you can calculate that a little bit later on. But when I have these earnings, well, $300 is more than $100, which means that I'm beating that metric. So that tells me I'm acquiring more assets. Now, the other thing is I'm also at a profit. So I have a double whammy right here. But there's going to be times where you're accumulating more assets, but your position is down. Reference A right here. This one's down $210, but I'm beating if I held in the market. So I've acquired more assets here, but it's down a little bit. That's fine. Market is going to fluctuate. Another option, this rendered soul right here. This is at a $585 profit. Yay me, more money in my pocket. But I would have had $30 more than if I were to just stick it in the market. So I'm losing compared to hodling in the market here. And again, this is one that I opened like yesterday. You got to allow these things time to perform. But that's an example. Another one where we talked about the double whammy, right? $15 in earnings. I'm profiting against holding in the market, and I'm putting extra money in my pocket. So that's best case scenario. And then actually, this is perfect, Mike, because it can show you all three scenarios.
Yeah,
But
yeah.
you gotta get the point. Like the goal is to choose your poison. My poison is accumulate more assets. So in this instance, I don't care if my positions are down 10, 15, 20%. I care if I'm acquiring more assets, if I'm profiting compared to holding the market. Whereas David, and again, nothing wrong with this because it's a completely different strategy. David's strategy is to live his life on the DeFi income, right? So he's at a point where he wants to basically kind of hedge out some of that exposure and just put more money in his pocket, produce income, not really worry about the upside, right? Just produce income, even if it comes at the expense of having the upside capped. And again, it's a question of, do you need short-term income, or do you have the availability to have long-term wealth building over here with a strategy like this, basically? Because this
Well,
does.
and that's what I always, tell people in our community
Mhm.
is, you need to ask yourself these questions before you start investing. What is your financial goal? Your financial goal is accumulate more assets. My financial goal is the same thing right now, but if the markets ever take off and I'm able to, reach my financial goal of $500,000, then I'm going to be switching over to David's strategy where
Yep.
I just want to earn income off of it, where I can build another DeFi portfolio. And then I'm going to do both. I'm going to make sure I have my treasury that I don't dip in the principal. I just earn yield on it. And then with that, I build a whole nother DeFi portfolio so I'm basically doing both. I'll be
Exactly.
gaining assets and generating revenue.
Exactly. And just for reference, like in the bull markets, like right now, I'm trying to accumulate more assets, as you mentioned, because we want as much upside as possible. Because to me, like, I don't mind waiting 6 months if it means I could have a 3x compared to if I'm generating 100% APR instead of 60% APR, right? I don't mind waiting 3 months to kind of get more income or something like that. But and the other thing is when the bear market comes into play, I don't want to just be in a constant spiral of, oh yeah, accumulate more assets, let's go, while the market's down like 50%. Like that's not
Yeah.
really logical. So in the bear market, the strategy switches to preserve the capital, exactly what David's doing right now. Preserve capital, generate income. So when we think about that in a bull market, we're buying, compounding, buying, compounding, buying, compounding. In a bear market, a lot of the times I'll actually start to take profits, not by selling, but by, since I have such a high amount of capital built up now, using the income from that capital to take profits, right? So if I were to put this on like a whiteboard or something, basically it looks something like this, right? This is our bull market, and then this is our bear market. At this point in time, we're accumulating assets, right? At least for me, again. And we're stacking our assets, we're dollar cost averaging and stuff like that. And then maybe we started with $50,000 in the market, and now we have a total of $250,000 in the market, right? Well, we now have a significantly higher amount of capital. We can take that 250K and we can focus on preserving it. And then ultimately, when we preserve that capital, maybe we're doing 20% instead of 60% a year or something like that. And then that 20% on 250K, well, that right there is 50K alone that you're able to pull out per year in income,
Mm.
in stable yield. That right there is what's going into my bank account. And guess what? By the end of the market, say it lasts 2 years, we pulled out 100K, double what we put in, right? So we
Yeah.
take out basically our entire principal plus extra. We keep this
Mhm.
250 in, which was our income generator. And then guess
Mhm.
what? We repeat the cycle. When the market starts to go back up again, that's where we want to flip it. Now, this time, we're going in with 250K. And
Mhm.
maybe this time it's only a 4x because of diminishing returns. So
Mhm.
you end up with $1,000,000, right? And again, this is over the course of roughly 8 years. Do keep that in mind. But like, just for perspective, and again, that's better than any return you're going to get in any other market. But
Oh, yeah, yeah.
yeah, like over the course of 8 years, we're not talking 50K to $1,000,000 over 2. So that's kind of the strategy that I take. But yeah.
Well, let's go ahead and dive into the functionality of metrics. Like I said, I definitely want to learn what some of this. There is a chat assistant, an AI chat assistant that I've been using a little bit to down in the bottom right hand corner that kind of answer some questions about what each of the if anything that you want to know. But
Yeah.
I have noticed that it doesn't like I was asking about retention on the earnings panel, and it couldn't see
Like,
it. It was
I
it was
don't know
saying
what
there
that
is
is. Yeah.
nothing.
Yeah.
Yeah, there is
I
nothing that says retention, and I'm like, it's in the earnings tab, and
Yeah.
so anyway,
I
let's.
get your messages, Mike. I I have one on my phone right now. What is asset gain from 2
Yeah,
minutes
yeah,
ago?
yeah. Uh,
But yeah, I mean,
hey, are you watching me?
yeah, I get them all, man. But yeah, so my team will dive into all that. But occasionally, if there's something urgent, I'm like on my computer or something, I see a notification. I'm like, okay, well, let me go handle this. But yeah, with the live chat, mainly AI is going to solve it. So cool thing is that pulls from our documentation. Sad thing is we haven't updated the documentation in like 2 weeks or so, which we recently introduced earning retention. So we just got to go in there and throw that in our documentation. Once we do, it picks it up. And we are building a better like backend process for as we release functionality to update documentation. It's just we've been building so fast. It's like as we build things, we push them out. As we build things, we push them out. And eventually we'll move to a model where we'll kind of push things out every 2 weeks. So that way it's streamlined. Push things out every 2 weeks, update docs every 2 weeks. Push things out every
Yeah,
2 weeks, update docs every 2 weeks. So that way it's because we have different people that do different things on the team. But in terms of actual functionality, Mike, to dive in, we have 3 different things. We have discover, we have simulate, and we have track. And this is kind of like how you think about where you're at in your LP process. And I don't mean journey because journey would represent like I'm a beginner versus advanced user. I mean process, right? Are you in the process of finding new pools, like reevaluating your portfolio, stuff like that? Are you in the process of managing? So if you're in the process of managing, it's oftentimes going to be completely fine to just jump straight to track. But today we're going to go from the beginning, basically. We start on the discover because we need to find pools. And then after we start to find pools using this, we're going to dive into simulate, where we're going to back test results and truly see what type of return we can get. And then after that, we skip a couple steps for the time being, but you would go and deploy and stuff like that, open up your positions, and then track your performance. So that's kind of the process that we have as of now. Now, in terms of discover, you can think of this as like a DeFi Llama yield section, right? But specifically for concentrated liquidity, which means we can give you more specific data on concentrated liquidity. On top of that, we can get a little bit more granular because we can pull more data without it being too costly because we don't have to pull the amount of data that DeFi Llama pulls. So one of the things that you'll find up here, and I do want to mention, we have 2 plans, a pro plan and an elite plan. A lot of what I'm going to be using today is on the pro plan. Some of it's on the elite plan. And I think Mike has a referral link that he'd like to share with you guys if you do wish to sign up to either of them.
actually, yeah. Real quick, in the description of the channel and all of our episodes, there's a 10% off. Jake was cool enough to give a 10% off link for all of our viewers. So thank you for that.
Yep. And another thing is we did just get rid of trials because we were having some abuse, but we do have a 7-day unconditional money back guarantee. So if you sign up within 7 days, you don't like it, as long as you hit it within the exact minute of 7 days, you're 1 minute over. Unfortunately, we have to honor the policy. But if you hit it within 7 days, we'll refund you. Just open up a live chat. Let us know, hey, like, didn't like it, whatever. We'll give you a refund. And that's like not even announced yet, but I'll announce it here. So yeah. In terms of discover though, right? We can head over here and we can start to search by specific tokens. So if we want to look for stuff with ETH, we're going to find a lot of things, right? If I just select all these exchanges and networks, we have 1,600 pools. That's a lot of things. So I wouldn't recommend searching by ETH. I'd recommend searching by, say, ETH and other assets or something like that. So if we were to do Aether, right? So ATH, just type that in. Boom. There you go. It's going to show all the pools with Aether in it. And what this is doing is this is not running a search based on a specific asset. This is running a search just based on any text that contains this. So you'll see that we have stuff like, let me find it. There used to be a token called Math. I don't think it's under here anymore. But yeah, you have these other like Aether tokens right here that aren't the same standard Aether that we're looking at right over here. It's going to show both of them, which is pretty convenient. So you don't have to be locked down on a specific token. But that's just one of the main things that you can do up there. The other thing that I want to dive into is selecting exchanges and networks. So you can choose which ones you want to browse across. Now, the ones I like to browse across, primarily, I will do Uniswap, PancakeSwap. I won't really look at QuickSwap or SushiSwap as of now, just because I haven't found great opportunities over there as of recently. But if you want
You're
to
going
select,
where the volume's at.
yeah, exactly. You go where the volume's at. And
And I always, me personally, I mean, real quick, I usually go to DeFi Llama and just take a look and see where the volumes are at, and then I'll go to Metrix Finance, select those, and just basically, I know that where the best places are going to be.
yeah. And then as far as like selecting these ones, right? So let's say we were to do Uniswap and PancakeSwap. We can then go and select our networks. So it's going to show us all the networks that Uniswap and PancakeSwap are on that we support, which for the most part, we support all of the active networks. Some of these things, they have like, 50 networks that they support. And like, it's just a bunch of change. Like you have 200K on the overall network TVL, which is, we're not going to spend time supporting that, unfortunately, unless a ton of users want it for some reason. But if a ton of users wanted it, there would be more money on there.
I'm
So
not going to be even entering a liquidity pool unless it has 250K in it.
yeah, exactly. So we'd select our networks. Again, you can select all of them. My process, I'm typically selecting Ethereum, Arbitrum, not as much volume and optimism, so I don't really favor it as much. Select Base, BNB chain, and we'll dive into Solana in just a second, but I don't like to select EVM and Solana at the same time. And that's not because of a limitation behind metrics. That's just because it's different data, right? Like they're going to have different minimum TVLs and stuff like that. So the last thing I want to do is filter by a million minimum TVL on EVM and filter out a bunch of good Solana pools that might have 750K or 500K TVL.
Okay.
So that's just something that I like to do, keep them separate because I'm segmenting based on what's going to be bundled under my filters. So that's the starting point. We'll start with these EVM ones. And then for a calculation time frame, this essentially allows you to choose how much data you want to factor into the APR calculation, which the APR is calculated based on average daily fees and average daily volume. So again, that 30 days will adjust the average daily fees and average daily volume. It essentially just adds up the 30-day total, divides it by 30, boom, there's your average daily volume. So there's an argument to be made that sometimes 30 days is not the best thing to have selected. For example, if I were to just get a general pulse by pulling up something like Ethereum to wrap Bitcoin, and we were to take a look at this volume history, you'll see, I mean, I think we can all see that this volume history has somewhat climbed over the past 30 days. It's more active volume spikes kind of the second half of this. And on top of that, they're higher, right? And just the general volume is higher. So it would make more sense for me to use a 14-day calculation range because the data in the past 14 days is different than the data in the past 30 days. So that's why I like to select 14. Now, with that being said, after we've done that process, we can begin to filter different pools, sort different columns, stuff like that. So one of the main things that we have is just this pool filter. So if you want to very quickly see, hey, ETH USD options, just like that. We type in ETH, we type in USD, and then from there, it shows us all these ones that contain ETH or USD, basically. We can easily evaluate them, pull them up and stuff like that. We have a better tool for that I'll talk about in just a second, but that will filter by the specific assets. Or if you want to look at ETH with specific assets, like let's just say Aether, Render, GRT, Sol, BTC, we type in must include ETH, include Aether, Render, GOT, Sol, BTC. Now we see ETH BTC. We see ETH Sol. We see ETH Aether. We see all these different, pairs of ETH that we specifically said we want to see. So it makes it very, very easy for saying, hey, I got these tokens. I want to find the pools that these tokens can be put in, basically, and evaluate them from there. So that's another cool option as well. In this instance, though, let's say we want to find completely new pools, assets we haven't heard of. We can filter by APR, TVL, correlation, and all these other columns because we have 903, and I am not looking through all 903. So one of the first things I'll do is I'll do APR. Usually I'm in higher than 30% or so. And 30% truly doesn't mean 30%. You're probably wondering why. That's because when you dive into concentrated liquidity, you have a range. Tighter your range, the higher the APR you earn, the broader your range, the lower the APR you earn. And no, you can't just dive in with a one tick, super, super tight range. Otherwise, you'll probably end up losing money. So there are caveats to specific ranges and stuff, which we could do a whole nother session, probably with David some time on that. But in terms of this, you'll see I'm on Wrap Bitcoin paired with Ethereum. We're showing a 10% APR. As I tighten up that range right here, that APR adjust starts to get higher and higher and higher, basically. So again, 30%, that could easily mean 40, 50, 60% if you go in with a tighter range. And some of these pools do need tighter ranges just to be a reasonable return. That's completely fine. But that's the first thing I do. Second thing I do, TVL, I like to look at, in this case scenario, we'll probably look at higher than $500,000. If you want fewer results, fewer results over here, you can do above $1 million and just be a little bit more strict. But there are going to be those times where you accidentally factor out something that's $800K, $900K, or even something that's $500K. That's just a really, really, really good pool. So do keep that in mind. Correlation. This is essentially telling you how correlated the assets are. This right here is a pretty big game changer. It essentially, we were able to implement this when we bought up cryptocorrelation.com. And this is a tool. This is one of our other tools that provides an analysis on correlated assets. You can say, hey, what assets are correlated to BTC? It will go and it will browse all of this in just a second. Yeah. So you can see all the correlated assets to BTC within the top 250 cryptocurrencies. So that's the infrastructure that we use. But we have the correlation over here. And then I usually like to look at higher than 0.5. We look over here at average daily fees or so. I don't filter by this. A lot of people like to filter by average daily fees, but I don't like to do that because in this instance, there's 50K average daily fees over here on Ethereum to Wrap Bitcoin. But there's $117 million in TVL. Obviously, something that has $6 million in TVL is going to have significantly lower average daily fees. So again, don't like to filter by this one. What I will do is I will filter by daily fee to TVL. This essentially is a ratio. So this is something that we can filter by because it divides our average daily fees by the TVL. So in order to determine a good ratio, because I don't have a set one, I have a dynamic one. I like to cut this list in half, right? So we have 97 pools. I will sort by the highest fee to TVL ratio. This does not mean that it's doing a higher return. This just means it has higher trading activity or higher fee collection from traders compared to the overall TVL. It's an indicator of pool health. The higher, obviously, the better. But again, you'll see, this is 750% APR over here with 0.36% compared to 250% APR with 0.8%. Not an indication of APR. And we'll dive into why in a little bit. But I sort by the highest, and then we have 10 pages. So I'll go over to page 5, and I'll just cut the list in half, right? I'll look at higher than, say, in this instance, 0.0514. So we do higher than 0.0514, and boom, that cuts that thing in half, basically. It's looking at the better half of the list. So that way we don't have to browse through as many results. And just to let you know, again, that same exact filter could end up eliminating some of those gyms, but you don't have to look through as much. And we are looking at the better half already. So lower probability. But more filters you add, more things you're going to cut out, and more things you cut out, more risk of potentially filtering out really good pools. Just because they don't look good on paper doesn't mean they're not actually good. because and some things over here will look great on paper, but they actually suck, which we'll dive into how you can evaluate that in a little bit. But 49 different pools, that's enough to look through for me. I can quickly browse through these. In terms of like what I'm actually doing here, I'm referencing CoinGecko for these tokens. So like if I don't know what Zora is, let's just say, I'm pulling up Zora, right? We pull it up over here. We go to the website. It will ideally tell us what Zora is. In this instance, it looks like a social media platform.
Yeah, it's that new base social media platform that everyone's going crazy over.
Exactly. Yeah. So like exactly what it is basically. So like, and then I can decide if I want to invest into there. So I would ideally run like a quick like ChatGPT analysis on like Zora, like where does it generate revenue? Does it bring that back into the ecosystem? How's it looking in terms of like volatility? All that
Basically,
stuff.
you do your fundamental analysis.
Yep, exactly. So yeah, that's like what I'm referencing. I'm just cross-referencing. Eventually, after you've kind of been through this, you'll see a lot of the same like repeat tokens. So you don't have to do that as much. But as we start to find pools that we like over here, we can start to favorite them. So for the time being, I'm just going to clear my favorites. Let's just say, I know, Mike, you're a big fan on Arrow. Let's just say we like Arrow over here, right? At 55% APR, it seems pretty decent. 532K in TVL, 93% correlation. Looks great on paper. So we can favorite that, which we can find over here. And then from there, later on, we can go and just start to simulate things. And I'll dive into like simulation in a sec. But yeah, I mean, ideally, you're just picking options that look good to you, picking tokens that seem like a good fit for your portfolio. And then once you have like those kind of favorited, you can dive into actually simulating them. So the goal is to take on Discover, having thousands of pools to having maybe 10, 15 that we want to simulate. And then from simulate, we start to simulate them. Maybe we have 5 that we want to actually deploy our capital into. And then after we deploy our capital into, then we can track the performance. And just like a interjection, again, feel free, guys, any questions, throw them in the chat. I'm happy to answer anything if there's a specific thing that's somewhat confusing. But when we think about Metrix Finance, I think of it like a funnel. Basically, I feel like you get the least accurate data when you're on the Discover page. And when I say least accurate, I don't mean like actually inaccurate. I just mean like relevancy, I guess is the term, right? Like we haven't dove into this Arrow ETH pool and started to simulate it. We haven't adjusted our range, right? So we're looking at 55%. This could be 30%, or this could be like 100%, depending on what our range is, and depending on how many days we factor into the calculation, because we need to fine tune this based on actual data, depending on what the liquidity distribution looks like, depending on all of that. So I guess least relevant data is what we'll call it. And then in the middle, you get relevant data on simulate, right? And it's going to be pretty dang close to being accurate. And then when you get to track, you get the most relevant data on track. Why? Because that's actual data based on what you've been in the pool. That's actually, hey, you invested this amount of money, you've generated this much in this many days, right? And that is this annualized return. So think about it like that in that regard, basically. We're essentially refining our strategy. We're not just looking at like, a line item right here and saying, boom, $50,000. No, we're actually doing back testing and looking at different data points. And that's what Metrix Finance is built for. And that's what our competitors don't have. There's a lot of great tracking tools out there in DeFi. I still think Metrix Finance goes into the most data and provides the most details, but there's not a lot of discover and simulation tools out there. And I'm starting to see like rumors of some popping up from other companies and stuff like that. A, they're either a copy of Metrix Finance, or B, they don't really go into the level of data you actually need to go into to conduct a proper analysis. And C, I've seen actually, there's a recent one that popped up that was literally a fork of like the Uniswap fish that we originally forked as well. But again, we've added so much in the meantime, which is what makes this like just so powerful. But let's dive into simulate. So we've got one of our pools, which we're just going to do one for now because we don't have hours and hours and hours to dive into this. So this first pool, Ethereum Arrow, we can flip this thing up at the top. That does not change any returns or anything like that. That just simply changes pricing terms. So I don't like to look at these annoying decimals like 0.00002 as my range. I'd rather look at how many arrow equal 1 ETH, right?
Mm.
And that gives me a better kind of indication. Now, with that being said, at the top, we see estimated fees. This, I don't want you to pay attention to it yet because, again, we need to refine things. We need to look at different data points. We need to adjust our calculation methods. And then from there, we can make an educated assumption on what our actual estimated fees might be. So the first thing I do is I enter my deposit amount. How much do I want to deploy into this pool? Is it $10,000? Is it $50,000? Is it $100,000, right? Enter in any amount. Let's just say for this instance, we say $25,000. We type that in. Now we can reference this a little bit later on because again, our range is going to change those ratios. But in simple terms, this will show us how much of each asset we need, the percentage of the total amount of capital, and of course the dollar amount that is worth at right now's current price. So the next thing that we're going to do is select our range. We've entered in our deposit amount. Now we select our range. So I like to start by thinking about how long do I want to be in a pool? If I want to be in a pool for 14 days or so, and I want to set my calculation time frame to 28 days, 2x it basically, because we want to look at 2x the data in order to be in, for the ideal time. And when I do that, I can set my min price at the very, very low of the 28 days, my max price at the very, very high of the 28 days. That's my initial starting point. Then we can refine from there, right? Well, we're somewhat close to this max price. And if the trend goes up again, we'll probably go out of range. Let's add a little bit more buffer room, right? Say we put that at 4,200. So that way we can encapsulate any jumps like this, right? For at least 2-3 times. And then from there, we can adjust our min price, right? So in this instance, I have 58% Arrow, 43% ETH. It depends on which asset I want more of, which asset I'm more bullish on. So when this chart is going down, that does not mean we're losing money. It could mean we're losing money. It does not mean we're losing money, though. It's not a general indication of that. This chart going down means it takes less Arrow to equal 1 ETH. So let's take a look at a couple different scenarios, basically. If the price of ETH is 4,300, and then the price of Arrow, Mike, what's the current price of Arrow?
It's like $1.15, I believe. Hold on one sec.
$1.18.
$1.18.
Yeah, I was just testing you. I'm like, I was pretty close on ETH, 4,305. It's been I haven't looked at it since this morning, so I guess it hasn't moved much. But yeah, so $1.18, 4,305. So when we look at that, right, ETH, Arrow, and then we have ETH Arrow, which is, in other words, how many arrows are in one ETH? We divide ETH by Arrow. That's why it's ETH/Arrow. We look at that essentially like this. We have 36.48. That's the current price of the pool. So when Arrow rips and it goes to $1.50, the price is 28.70. We made money right there, but the price went down, right? That's because it takes less Arrow to equal 1 ETH. Price of ETH stayed the same. Arrow went up. That means it went down. Now, what happens if, and I'm going to map out all these scenarios actually. What happens if the price of ETH goes down to 42.05 and Arrow is the same at $1.18? Guess what? The price slightly goes down. What if it goes down to 4,000 actually? Goes down a little bit more, right? Still, in this instance, we would have lost money. So lost money, I'm going to say lost dollars, not lonely dollars, lost.
Lonely dollars.
And then over here, we made dollars. And then in this instance, let's just say both of them go up 10%. The price will stay the same, as you can see, right? In this instance, we still made dollars. What happens if, the price of ETH goes down to 4,000, the price of Arrow goes up to $1.50? Well, in this instance, we probably made dollars. I'm going to take an assumption and say we did, but the price went down significantly, just because I feel like that's a greater move than that. But yeah, we map all that out. But my point is, like, this is outperformance or underperformance, we can call it. One asset is doing better than the other, therefore this pool price is adjusted, because we're looking at how many arrows equal 1 ETH. So say we were to choose this range because we think Arrow is going to do well. Maybe we tweak it a little bit, so we bring this down a little bit. So we could have 60% Arrow instead of 40%, because there's going to be selling in your liquidity pool. So you might as well start with more of what you think is going to do better. right? So if I think Arrow is going to do better, I store more of that in a liquidity pool. So that way I can have more exposure to it and more of it being sold. So I make more dollars. And then after we've done that, our range is chosen, our deposit amount is selected, right? We move into saying, how accurate is this? How accurate is the 126% APR? So one thing I want to say is Metrix is a powerhouse. It is a powerful tool if you know how to use it right. If you don't know how to use it right, it will not do you any good, basically. Because if you're looking at 28-day data, in this instance, we're doing 15, 10, 8 million dollars, all the way back to the beginning of the month. And now recently we're doing $2.5 million. It's a big sway right there. We're factoring in these $10 million days, despite recently only doing $2 to $3 million per day, which what does that do? That affects our average. Our average is $5.5 million or $5.75 million on a daily basis. But we have not done any of that recently in the past 2 weeks or about a week and a half or so. So we don't want to factor in this data. It's one thing that makes Metrix so good. We make it so you can factor out that, right? Instead of just giving you like a one size fits all number, like based on one day or based on like 1 year, we give you the actual ability to adjust that. So when we dive into it, let's just say days since August 26th, it's been 10 days. So our calculation time frame, we will now adjust to 10 days. You can see that's now an average of $2.86 million. So when we look at that, that's pretty in line with what we're doing recently, which means that this return over here is going to be more accurate than what we just looked at. But there's one more step to this, and that right there is calculation method. So with that being said, our calculation method is essentially how much liquidity are we factoring in, right? Obviously, there's 510K, but there is 2.7K on this price point. And then over here, there is $290. So we have to choose which one we want to calculate on. By default, we calculate on the current price. But in this instance, there's 2.2K on the current price, but just a little bit to the right if there's the slightest movement in one of these assets, basically, and the other one doesn't move, there's 2.7K of liquidity. So if we dive in right now, Mike, we will get 62% APR. But the thing is, if the price goes over here, we're now getting 61%. If the price goes here, we're getting 58%. And if the price goes over here, we're getting 50%. Because there's more liquidity on this price point. And we have...
So it's splitting the fees amongst more people then.
Correct. And let me do the math behind that, basically. We have a $25,000 deposit, and we are deploying across 221 ticks. That's what that ticks in range is, basically. 221. So if we have $25,000 and we're deploying across 221, we are putting $113 per tick. Well, on this tick right here of 2.2K,
that's a larger portion
it's
of
a
that
larger
tick.
portion compared to 2.7K. So on the 2.2K, we make up for roughly, about 5.14%. Whereas over here on the 2.7K, we make up for roughly 4% or so, 4.2%. So we're going to earn a lower share of the fees on here, which is why that APR is adjusted, basically. So ultimately, that's why we have to make sure, number one, we adjust the calculation time frame. So we're factoring in the recent and consistent volume history. Number two, we're adjusting our calculation method, or in other words, looking at different periods to see what we can do. And I would say realistically, we'll probably get 62% diving in here. We just have to know there's going to be times where we earn, 50%. There's also going to be times where we earn 82% because there's less liquidity over here. But also, this liquidity is going to move over time as the price moves. So you just have to know kind of that general range and general indication, and make sure you're comfortable with all aspects of it, basically. But I want to, before we dive into the rest of Simulate, I want to open it up for questions. Anything you have, Mike, or anybody in the chat?
Let's take a look. Let's see. I did star one question, but it didn't. I want to save it till the end. It didn't have to do with metrics, so I don't want to get on a rabbit trail.
Okay. Yeah. No worries. Awesome. Then we can dive back in. So
yeah.
That is the basic functionality so far on Simulate. Next thing that we have is our Simulate position performance. So I'm not going to dive too deep into like finding the actual price points, but this will help you determine if your position is actually going to be profitable compared to holding the market. So you generally would want to go see how much can Arrow swing in a day, how much can ETH swing in a day, right? And see like if they're actually truly correlated. So if ETH can swing to, let's just say, $4,500, so plus 4% or 4.5%, but then Arrow can swing up to, let's just say, $1.30. That's plus 10%. That creates that divergence, right? That lowers the pool price. Therefore, meaning while we started with 60% Arrow, 40% ETH, we now have about 50% of each. And you could see that there's roughly $93 of divergence loss here. So now we're asking ourselves the question, if it can swing this much in a day, how long does it take to outweigh 1 days of impermanent loss? In this case, 2 days. But the thing is, you're not going to see those swings every day. So do keep that in mind. You're going to have your periods of consolidations. My general indication is about 2x the period. So if we can swing, let's just say, and we like to analyze across like 3 days, 5 days, 10 days, stuff like that. We analyze across different horizons. But if we're like looking at it like, okay, there could be this much impermanent loss over 10 days, at most, we want that to be outweighed in 20 days by fees. Because we also have to factor in profitability. Like we want to generate enough fees to profit, not just outweigh divergence loss. So our days of active position, if we're in here for 3 days, and it tells you how many you need, if we're in here for 3 days, we generate enough in earnings to outweigh the opportunity cost / divergence loss or impermanent loss. All of it's the same thing, guys. We just use different terms. Because most people know impermanent loss. We think it's better as divergence loss, but it truly is just opportunity cost at the end of the day. So yeah, does that kind of make sense, Mike, on this simulation part?
Yeah, no, it definitely does.
Awesome. Yeah. So, and again, we'll do the downside as well. So say ETH goes to $4,000, down 7%, and Arrow goes down like to $1 or something. So down 15%. Well, now we have 268 days of impermanent loss. This realistically probably happens over 3 days or so. We need 6 days to cover this. So this is actually not a bad pool to dive into, basically, because we back tested it and we said, hey, we can beat divergence loss. As far as this other chart down here goes, along with like some of these metrics like geometric mean, we're not going to have time to cover those today. But this is essentially just from a high level showing you how much of each asset you have at specific points in time, specific prices. And that's based on pool price, not dollar price. Over here by value, this is showing you the total value in the quote asset, which is the second one in the pool. So Arrow in this instance, total value in Arrow at specific prices. So same thing as this, just showing you the actual value in Arrow. And then over here by total value, this is just the overall pool's total value in Arrow at a designated price. So yeah. And then the next aspect that I want to show you guys is actually saving this. So say we're like, okay, this is something that we want to dive into, yada, 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 right? Saved a portfolio. Or maybe it's like we want to do further research on it or something like that. Saved a portfolio. That will take it over here to build. Now we can go into build, and this usually takes a sec to load, especially if you have a lot of them, because it pulls all the data in real time and it's doing it for multiple. I'm going to remove these two for now. But this is essentially all your saved simulations. You hit simulate again, it now pulls it up with all the saved information and everything like that. You can also grab that thing. You could share it directly with people in our Discord community. You could share it with people in Mike's community. You could share it with anybody, basically. Just share the link and everything pulls up. So that's one of the cool things. The other cool thing is once you have multiple positions in here, that same simulate process we just went through, we could do it for all of our positions at once, basically. So we could simulate the potential returns all at once, which is great because if you're mixing in ones with different risk levels, you could see the super risky ones earning the highest amounts of money, right? That maybe are pretty correlated or something, just low market cap. They're helping your other positions as well. So that's another pretty cool thing. And you can also share the portfolio. You can choose public or private and then share a URL. Now, another thing that I want to dive into is on our simulate, we have something called pair. Now, this right here is kind of like our bread and butter, I should say. Or simulates our bread and butter, but this is something that I've never seen on any other tool. And DeFi Llama has something similar to this, but for lending and borrowing. But it's simply like, hey, like let's browse across. And again, let's just say we were to do these ones, like actually Aerodrome as well. Because we're looking at Arrow in this instance on like Pancake Swap base. We haven't even looked at Aerodrome. But we're like, hey, that's the one that we found on the filter or something, you know?
Yeah.
So let's look across, and I'm going to assume that we're just on base. So that way because as you select more, you start to see it lags a little bit, because again, it has to go and load all that data in real time from all these exchanges and networks, which is going to be a ton of different pools. It's loading like 4,000 or 4,000 of them. You can see I just broke it because I was impatient. Try to refresh it. So let's go over here. Yeah. So taking a look over here, we'll do exchange. Let's just do these ones. And then network, let's do base. And then that'll load up all the tokens on base. We type in ETH, and then we type in arrow, right? Give it a sec. It's going to go and load all the Ethereum to arrow opportunities across these exchanges on this network. But that's not all. And the reason why is because Discover can do that. What we can do here that we can't do on Discover is we can enter our range. So if we take a look, our range was 2870 to 4215. 2870 to 4215. We can also adjust the calculation time frame. So we chose 10 days. Now, I'll say 10, it's not one size fits all here, because sometimes you'll have pools where the volume goes down on like one pool and it goes up on the other because the market shifts to want to go to a lower trading tier or something like that, right? So you always have to say, like, even the one that's doing the highest return over here, you have to dive into it and compare it to your original and be like, okay, it is or it isn't doing the highest return. And then as far as deposit amount goes, we can also enter that deposit amount. So we said it was 25,000. So Ethereum to arrow here, $37 a day, $30 a day. Over here, $12 a day. Over here, $42 a day. And then over here, $21 a day. So it seems like the one that we selected originally is the best one. But
I really like this because
yeah,
I mean this would save a lot of time and a lot of calculations. So I mean, yeah, if you can basically build out a position
yeah,
that looks good, for the two assets, load it into here, then it will basically just go out on all these different protocols and find the most profitable place, and then you can just enter that one instead of just going to Aerodrome and just being like, well, that's the wrapped ETH arrow position
mhm,
that's on there. You can basically see Pancake Swap, Aerodrome, Uniswap, all the other different ones, and find the one, using the same, amount of assets, the same amount of capital, liquidity that you're depositing, same range, same everything, and see which one based off of the TVL and all those other variables, which one is going to make you the most.
yep, exactly. Yeah, said
Perfect.
perfectly.
No, that's freaking beautiful.
And yeah, just regarding this, like, again, the reason why we always test as well, like, so there's a couple here, so I can just open them up in new tabs, quickly see, is because again, there's going to be times where, like, this volume is picking up over the past 10 days, so that's pretty reasonable. We want to look at liquidity distribution as well, because it might show it has a higher return, but maybe it's like right over here, right? It's right to the right of where you're actually getting a lower return. We have to factor that into our analysis, right? So that's why I say
Hey,
sometimes things could be good on paper or bad on
real
paper.
quick, Stu has a statement. I want to make sure that because I didn't see this. He said
Yep.
it shows staked versus unstaked on Aerodrome as well.
Yep.
I mean, it does that.
So that's right here. Yeah, where you can toggle it between staked and
Oh,
unstaked.
nice,
Um,
nice, good catch, Stu. I didn't see that.
yep. 95% of the time you'll get better returns on staked. I will say that. So
Oh
like,
yeah, yeah.
yeah, yeah.
Well, because on Aerodrome you lose 10% on unstaked. So if you stake it, you're going to get paid an arrow and you get the full amount. If you
Yeah.
go unstaked, it's going to pay you like on Uniswap in the two assets, but you have to pay a 10% fee
Yeah.
to VE arrow holders.
Yeah, yeah, exactly. So yeah, you can toggle between there and you can check different ones. But yeah, I mean, as I was saying, like some of these, they might look great on paper and then you dive in and they're actually not great. Now, I will say, and this is like personal feedback to ourselves, Aerodrome, when it comes to simulate, for some of the pools, is not the most amazing integration. And the reason why, and we're working on some cool things, and I won't it'll be super hard to explain here without models and stuff, but we have an idea in mind that will work really well. But basically, like, we look at this, and if we say, hey, like, what return are we getting? It might show we're getting a 258% APR. So from here, if it shows 258% APR, looks great. Let's go dive in. Let's throw all our money there. But then when we
Uh-huh.
open it, it's like we have this tier where we have $2.4 million in liquidity on a single tick. And then over here, we have 218,000. A huge difference. So like we're getting 23% here and then 258% here. So when you have that much of a difference and it's just on one tick, it's very, very hard to estimate what you're going to get. My say would be, I would look at where the price is and I would do kind of like a mental calculation, right? Because on Aerodrome, you have a lot of short-term liquidity providers. A lot of people like providing super tight range, use like a tool like VFAT or something to auto rebalance as soon as they get to the next tick or something. That's why you have these ticks with super large liquidity. But I'll look at the pool price, like where have we swung from? So since yesterday, basically we've been from 39.61. So then I want to look over here, basically 39.61. And it's hard because we don't have historical data for liquidity distribution, which we're working on. But like there would have been some time where you're earning, like significantly more, but then there also would have been time where you're earning like 23%. So if I were to guesstimate, I would probably say we do like 30% on this pool or something like that. Again, not the most amazing thing. We're working on different solutions. It's just people provide super short-term liquidity over there, which is why we run into this. And then also the other thing is our calculation time frame. We're now looking at reward history. So we want to look since like August 27th. So let's just say we did 9 days. Let's do 8 days because rewards will be a little bit more stable because again, they're paid out as incentives. So looking over here, that's a little bit more consistent. We're doing about 21%. So I would just probably go in the pancake swap on this one because I have a lot of uncertainty here on what I could get. It could be like, 20% at lowest. It could be probably 30% on average, or it could be as high as 100%, like we don't know because that liquidity is constantly shifting and stuff. So that's one of the limitations there, but that's primarily only on Aerodrome where you see that. So yeah, let's say we were to deploy into that one that we saved to build originally. We could pull that back up. In the instance of some exchanges, and PancakeSwap is one of them, big shout out to them, you can hit create position. It will take you over to their exchange directly. And in this instance, it will pre-fill the tokens, the fee tier, and even your range, which is great. In the instance of Uniswap, it pre-fills the tokens in the fee tier, but you do have to select the range manually. None of them we can pass deposit amount, but it's just kind of cool. Some of them allow us to pass that directly within the URL. So that way, you can open it like that. Others don't. So yeah, just make sure you're always pulling up the right one. Match up V3 versus V4, the exchange network, the fee tier, the assets, like match up all that and everything. But let's say we've deployed. We want to track our performance. Again, guys, any questions on Simulate, on Pair, stuff like that, throw it into the chat and we'll make sure to answer it. But I do want to do like a quick little call to action, I guess you could say. That Pair functionality right there, that's part of our Pro tier, which is $50 per month. But like, if you think about it, if you have $10,000 in a liquidity pool, and we'll just do the math together, like $10,000 in a liquidity pool, and you're earning 50% APR, that right there is $5,000 a year. But what if you find a slight optimization, right, by just going into another pool, same $10,000, now doing 60% APR? It's an extra $1,000 a year, which essentially covers the entire cost of the Pro subscription over the course of a year, basically. So that's one of the main benefits. You generate an extra $1,000 just by simply throwing it into that Pair functionality and being like, okay, do I have any pools where I can earn higher amounts of capital? That's what most of our members do, and it gets
No, because before Metrix, that's what I was doing. Is I would just go to Aerodrome or Uniswap, and I would just find a good APR on the assets that I wanted to do, and I would enter. It's like, with that Pair. I'm getting into the same assets, with the same ranges, but it's going to find the most profitable pool. Again, based off of TVL, how that liquidity is distributed, across the the spectrum,
Yep.
for lack of a better term. And so, yeah, no, having it, you always need to look at the tools that you use, and if they are making you more money than they are costing you. So in this case, yeah, no, just that one simple function, potentially, if used properly, of course, is going to make this, basically, like you said, pay for itself.
Yeah. And just want to give a quick case study as well. Like with that, like we've had clients come in with $100,000 portfolios, and they're generating like 30% a year. They put it in the pair, and maybe they're super blue chip or something. They put in the pair, they're now getting like 50% per year, nearly double. Like, they're going from 30,000 a year to 50,000 a year. So they generate an extra $20,000 by like a couple clicks of a button per year, like just for reference. But yeah, I mean, in terms of like our next functionality, track, and soon Metrix Finance will be a capital deployment tool as well. So when we say that, we don't mean we'll take custody or anything. Our capital deployment would basically, and management would basically be aggregating Uniswap, QuickSwap, PancakeSwap, Orca, Rate, all those in one dashboard. So it interacts directly with their smart contracts. Your positions are all stored directly on the blockchain. Still, they're not in our wallets; they're in yours. Except essentially when you go to rebalance or when you go to zap in, right, you can use Metrix Finance for additional functionality, like saying, hey, I got a bunch of USDC. I just want to swap right in. Will we charge you a fee for that? Of course, right? We'll have the lowest fees in the market as of what I know right now and what we're going to price them at, simply because we have a subscription model. Our primary functionality is a subscription. Compared to most companies, they are like they're a percentage of the fee a percentage of the volume that you transact, meaning that they're incentivized to get you to transact more on their platform, meaning that they're incentivized to build more tools that want you to transact more. We can build stuff that's like super, super, that won't make us any extra money, but just really enhances the user experience and gives you the data that you need because we have a bunch of subscription revenue, because we're a software as a service as opposed to just a capital deployment tool. But when we release capital deployment, since we have that aspect of it, the other aspect of our company, we can have lower fees than most tools. And we can provide discounts to our subscribers, stuff like that. So you save more on fees than what you pay. And if you're already using other tools, chances are by subscribing to a subscription, you will save money if you're using capital deployment on other tools as well. But in terms of track, this is after you've opened your positions on the respective dexes and stuff. You can enter multiple wallet addresses at once. So I have two right here. I have my EVM and my Solana pulled up. $65,000 in liquidity. You see your current liquidity. This does not include earnings. This is just how much you have in actual capital in the pools. You have your deposits and your withdrawals. So I had 64,816 in deposits. And then over here, you have your earnings, your unclaimed, claimed, and retention. We'll talk about retention in just a second. You have your profit loss, which is $213 total. This is your dollar in, dollar out. And this also factors in your earnings. So it's like, hey, Jake, you lost $100 from the market just going down a little bit, right? There's a $100 difference between 816 and 718, basically, right? But when we add in your 312 in earnings, you profit in 213. Now that 213 divided by that deposit right there is 0.33%. So you have a 0.33% return on investment so far. We can include transaction fees if we want. It's like $3, so I'm not going to worry about it right now. We have our versus HODL, which is how much we're profiting compared to holding the market. So this basically just takes your divergence loss and it subtracts it from your fees. So when we do that, we get versus HODL, and we'll be able to show that in greater detail a little bit later on. But earnings retention is how much of this are you keeping after divergence loss, which is a simple calculation of just dividing the versus HODL by the earnings. So 65%. So we're retaining 65% of our earnings basically in this instance. And the other, 35% or so are going to divergence loss, right? It basically is how you can classify it. And then your APR. Now, a limitation here that's going to be solved very, 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 very soon is this APR is the APR over the lifespan of your whole position. So if you're in positions for like 2 weeks like me, it's not a huge deal. But if you're in positions for, let's just say, longer period of time, like a month or something like that, and you started off earning 80% APR, and now you're earning 40%, your APR is most likely here going to show about 60% or so, because it's factoring in time where you were doing 80% in time where you're doing 40%. Whereas our new functionality will pull real-time APRs over the past day. So we'll basically be able to compute your APR on a daily basis, and then we'll be able to show you your 24-hour, your 7-day, your 30-day, right? So you can see the change over time, but also you can see the lifespan APR, and you can have the most accurate data like recently, right? Like based on your fees collected yesterday.
Well, that will be valuable because I mean it will help you better understand, when you go from being profitable to maybe breaking even or
Yep.
and catch it before you start becoming
Exactly.
or losing money.
Yeah. But the other thing to that is most tools will show you the 1 day APR instead of lifespan one, right? And that 1 day APR is also super unreliable when you don't have the
Mhm.
7 day, 30 day. Because if you're checking on a Saturday, your APR is gonna be like 10%, man. Like because nobody
Yeah,
trades
because
on
there's no
Saturday.
volume.
You know what I mean? So that's the thing, right? Lifespan's great. That's why I always like to, if I'm in a position for like longer than 2 weeks, I'll go and I'll re-simulate it, right? Same range. I'll just adjust the calculation range and the liquidity distribution just to see like how it's actually doing. We showed 24-hour, 7 day, and 30 day projection, but that is just like current liquidity times APR that's showed right here. And then also like equate it to 7 days, 20, yeah, multiply. And then a couple other things that I want to show as well. You'll have all the positions across the dexes and exchanges that we support. Again, only concentrated liquidity as of now. We do have functionality to add your own positions where you can go in with CoinGecko IDs and it will pull in prices automatically. All you have to do is log deposits, withdrawals, claims, and then when you want to view performance, check to see how much you have. And we have some cool stuff up our sleeve to make this like 90% automated. So think about it like this: like if you had a position that you are running or something, all you have to do is like register it maybe and say, hey, like this is a position I'm running. I'm registering it on Metrix because Metrix doesn't support it, but then it can automatically use AI and stuff to log the rest of it, which would be pretty cool. That's some stuff that we're working on our long-term vision. So that way we can support anything for tracking that, even if we don't support it, basically, and make it super seamless for the user. But we have our opened or closed positions or all positions. And then we have over here our search. So if we want to look specifically at serve, we can search serve. It'll show us that. Render, show us that, and it aggregates that data right up here. We could select specific exchanges that we're on. So like if we want to look at our Uniswap versus our PancakeSwap, or Hyperswap, or Radium, stuff like that. Same thing with networks. We can look at the opened after date. So in this instance, we just by default use a year. But if you want to go all the way back, you look at opened after a specific date. You can reset all those. The next thing is we see just a table list of all the positions that we're currently in. And we have our current liquidity, our earnings, our profit loss, our versus hodl, our APR, and when we opened it and our price range, just readily available for us. Next thing I like to do is just dive into these. So let's choose this one right over here, UBTC to hype. So over here, we see the same metrics right up here. Same aggregated stuff, but we have more data, lots of data that will help us make decisions. So first thing, under position composition, we have our current assets in the pool, the amount, the dollar amount, and the percentage of the overall dollar amount in the pool. So we have 47% of our assets right now in hype, 53% in UBTC. We could see our initial, which was a 53% ratio to hype and a 47% ratio to UBTC. So these things just essentially swap themselves, essentially. We can also see what would have happened if we held these initial assets. So if we held these, obviously we'd still have 271 hype, but that'd be worth 12,773 instead of 12,814. And that would have still been in a 53 to 47% ratio. So that's another cool thing. Earnings, you see your unclaimed, claimed, same thing, dollar amounts, percentages, and total down here. Divergence loss, that's where I want to put my focus. You see divergence loss across a ton of different metrics, right? How are you profiting compared to if you held all your money in hype? What if you held all your money in Bitcoin? What if you held it in a 50-50? And what if you held it in your initial split, which was 53-47? So in this instance, if we took $24,367, we just threw it all into hype, we would have $24,289 today. Since we're in the liquidity pool, we have 24,166. We have less, $122 less because we're in the liquidity pool. But when we add our earnings to that, that gives us our versus hodl. So this right here is our divergence loss, or some people call it impermanent loss. This right here is our versus hodl. We get divergence or impermanent loss by subtracting the hodl amount from our current liquidity. Whereas we get our versus hodl by just adding our earnings to that number. And then we calculate that across what if you did it on UBTC? What if you split this initial deposit into just two equal splits? How would that perform today? And then what if you just held 53.47? So yeah. Any clarification, Mike? Do you think I should throw on divergence loss or anything like that, or this table?
No, I definitely think you nailed it on that one.
Awesome, man. So yeah, moving forward, we have our price range. This is going to show you, and again, we didn't have this for the longest time. We launched it a couple months ago. This will show you when you went out of range. A lot of people have the problem of like they go out of range, but they don't know it because the next day they look at their position. They don't know it went out of range overnight. So naturally, they're like, okay, I don't need to do anything. But reality is, if you're looking at this price range, you're like, oh shoot, I went out of range last night. You should use that data to say, okay, well now I know that I could go out of range overnight. I probably need to adjust my range to be a little bit broader so I don't go out of range overnight in the future. So that's very helpful. You can see when you opened your position right over here. And you can see the price change over time. Now, over here, you could also see your min price, the current price of the pool, your max price, your average starting / entry price, and then the rate that you've been in range. So we've been in range 100% of the time. But if you're in range 99% of the time, that shows over here. On top of that, under this thing, a lot of people think this is the description. No, this is a very, very important piece of information. It tells you how much of one asset was converted to how much of the other asset at what price. So let's break that down a little bit. Our position composition. We started with 271 hype. We now have 241. We started with 0.1028 BTC. We now have 0.1153 BTC. So it tells us, hey, about 30 hype was converted to 0.0125 UBTC at an average price of 23.68 hype per BTC, basically. So when we do the math on that, okay, how much was this hype worth at our initial entry price? Let's find out. We essentially just take the total asset, and we're also going to add in those prices pretty soon. I don't know why we don't have them quite yet, but we entered when the price was about $47 per hype. We find that like that. And if we entered at $47 per hype, and 29 hype was sold into BTC, then the cost behind that 0.01 whatever BTC was about $1,400. So we can compute it like that, basically, of what we sold, which is a very niche metric. You don't really need it, but it's cool to be able to see the effect of your liquidity pools. So that's one thing. Another thing is this position liquidity chart. Or actually, I completely skipped over one of the most valuable features, price alerts. Being able to get an email of when you're about to go out of range and stuff like that. This launched about a month and a half ago or so. But when you're above or below a specific pool price, you get alerts also at specific compositions. So let's say we wanted to do this one. There we go. And then if we were to go back,
that's actually cool at the bottom where they it shows you all your transactions. So like, when you've collected fees, when you deposited, all that stuff too.
Yeah, it's awesome. And then we have this little thing over on the dashboard so you can see all your price alerts at once. So you know when you're gonna get alerted. And I believe these auto delete after they hit. Just for reference. But yeah, scrolling down, as Mike was saying, we have all of our transaction info here for our pool. And we'll dive into that in just a second. Our position liquidity. This is somewhat useful right now. It will be more useful when we bring in the daily earnings chart, so you can see your earnings on a daily basis. Like you earned $100 on Friday and then 20 on Saturday. But right now you can see all the HODL metrics along with your position liquidity, which right now this position liquidity is just the dollar value in the pool. So soon when we have the ability to add in earnings, what you'll be able to visualize in this chart is essentially how over time your position outperforms HODL metrics because it's generating more and more fees. You can start to view your position outperform because it's climbing more because it's generating more and more fees. That's the idea here. But for now, you can just see your position liquidity over time, which is also pretty valuable. This one in specific, I was down to 22.5K over here. I didn't know that, you know what I mean? Because the price fluctuated up and down, and you can't visualize that on this one because this doesn't mean you made money or lost money. You see your projections, which is just the same thing you see up here under the APR section. You see hedging as well. So hedging is a little bit more advanced. I want to say like literally less than 1% of our users use it probably. But this is where you can add in your shorts in the instance where you're hedging on like a third party platform or something like that. That way your profit loss isn't just your liquidity pool profit loss, but rather your overall profit loss after hedging cost, after your short made money, your long lost money, or your long made money, your short lost money. But for the most part, it just shows you your exposure right now. If you don't add a hedge, you don't add a short or anything like that. And then, as Mike was saying, we have this history where you can pull up the transaction hash. You can see the dates, how long ago it was, the type. So if you have claims, they'll show over here. Balance, the total value. We have PL that's specifically for the hedges when open and closing, and then transaction fee. Now, one of the most important things here is the actual edit function, because no other tool has this. Once again, the functionality where you can edit this is very, very crucial. And the reason why is because at the time of entry, sure, this was worth $12,814, $11,553 as of CoinGecko at that exact time of entry. Yeah, yeah. But the thing is, what if I bought this for $12,825, not $12,814, right? Because we have trading fees and we have slippage. Well, if you want to track the true profit loss, you'll need to dive in here and actually throw in the amount that you bought it for. We can't pull and we won't be able to pull the price that you bought it for, just because what happens if you acquired like some hype here, some hype there, some hype there, some a year ago, some 2 weeks ago, right? And then there's different calculation methods. We're not that type of tool. We're not Coinly at the end of the day, right? We're not a tax tracking software. But if you readily know the amount that you bought this for, go throw it in here. And ultimately, that will give you more granular data. Now, I don't do this too often unless it's like stablecoin positions, mainly because I'm using metrics as a general indicator of how my pools perform, how the strategy goes, how the strategy works, if the strategy is working. And then when I want to get like reconciled to the dollar, I do it within Coinly, which is a tax tracking software. But Coinly doesn't show all this data I just showed you. It just says, hey, you put 20,000 in, you pulled 21,000 out, you know what I mean? And tells you exact buy-ins and stuff and your exact sells, and you generated $100 in earnings. It won't show you impermanent loss or anything like that, or APRs or anything, just for reference. But yeah, I mean, Mike, that's all I have over the last.
Oh, wait, I mean, yeah,
20
I
minutes.
wouldn't say that's all you have. I mean, that's like, I
That's,
mean, that's quite a bit of data.
yeah.
And me being the way that I am is I almost exclusively operate off of data.
Yep.
I've been kind of zoning out on this position liquidity and messing with the the hodl 50/50 hodl. If I would have held 100% of one of my positions, I'm actually looking at my position that I'm out of range on right now, my
Mhm.
KTA wrapped ETH position, and it's really gives me a because I'm very visual. It
Mhm.
gives me a really good feel for how the position is performing versus because I entered the position with nothing but KTA.
Mhm.
And so even though I'm out of range, because KTA, of course, has been underperforming relative to wrapped ETH since I entered the position, I'm actually, according to this, my position liquidity or my deposit amount is actually outperforming if I would have just hodled KTA.
Yep.
So because it was DCAing me out of my wrapped ETH into KTA, I ended up with more KTA tokens. And
Mhm.
as that goes up, as that price starts moving back towards coming back into range, then obviously my deposit amount goes up because that basically KTA that I'm now hodling is going up in value. So it's really cool to look at these charts and see how when different variables change, how that affects my deposit value, how that affects my token count, all those different things, depending on like we were talking about at the very beginning. You're trying to accumulate assets
Yep.
because of where we're at in this bull cycle, whereas David is more of the mindset of this is how I make my living. This is how I put food on the table, keep a roof over my head. I just want to generate revenue.
Mhm.
So he, obviously doesn't want to, lose his principal value, the money that he's operating with. So, but he is okay with losing exposure to an asset as long as he's in the green when it comes to his principal, or
Exactly.
his investing money and the fees that he's earning.
Yep. Exactly. Yeah. 100%. So, um, ultimately, I believe Metrix is like kind of a liquidity pool workflow tool as of now.
Mm.
Like you kind of have your own little workflow, little process that you use, and it's super customizable. I will say I want to open it up. Like anybody in the chat, like if you have any feedback for us, if you have anything that you think we're missing, any exchanges, networks, throw them in the chat. Or if you think about things later on, this little bubble right here, just go to this bubble, go to ask a question, right? We get all these, even if you're just talking to the AI. And then
Don't do it. Jake's spying on you. He's watching me.
well, we get all the notifications obviously because
No,
um
that's a good thing. That means, I
yeah,
mean, the fact that that you personally are seeing the messages with people's questions, if they're not getting a proper answer from the AI, then you and your team can step in. So I mean
exactly.
that
Yeah.
it shows how much you care about your product.
Yep. And yeah, I mean, anything's confusing, also let us know. We're always looking for ways to better user interface. As I said, the way that we build things, since we're like in an ultra fast moving environment, we build things as quick as we possibly can. And we think the user interface out, how the experience works and everything like that. We publish them to our users. We let users like tear it apart basically. And then from there, we implement all the feedback and stuff like that. So like you'll see our Discover product, it's nearly flawless. Our Track product, like nearly flawless. But when it comes to specific aspects like custom positions, this is a little confusing on some certain aspects. So we're making adjustments there. And also trying to make it more streamlined for like less manual work. When it comes to hedging, we're also doing some things there and adjusting that process. Pair
Yeah,
was like that for a
I did
while. And we
I did see that tab where you could enter a hedged position.
yep.
Yeah, right here on hedging, it says add hedge. So yeah, no, that would be really cool to where you could try to, basically, yeah, get delta neutral, I believe is the term.
Yep, exactly. Yeah, and that's the purpose,
See that?
help
I
you.
learned that from you and David.
Yeah, awesome. There you go. Yeah, that's the purpose, try to be delta neutral and at the same time, like, be able to monitor your hedge. Cool thing is with your hedge, we actually don't have to track, like, you don't have to log a check for your hedge because if you enter your initial entry prices, we can just do the math on our end. Like, we can and obviously, it's not gonna include, like, funding fees until you, like, mark the hedge as exited, but, like, that way, if your liquidity pool is auto tracked and you add a hedge, your hedge is also auto tracked. Basically, it's just when you close your hedge, you just have to mark, "Hey, I closed the hedge and I made this amount of money." And then, "Hey, I opened the hedge and I entered with this amount." Basically,
So those that aren't familiar with the term hedge, it's basically a way to mitigate risk.
yeah,
So would that be a good summary?
I would say market exposure, but yeah,
Okay.
that's the general purpose. So,
All right. So Joseph had a question at the very beginning. I told him, I promised him that we'd get to it. I'm going to let you take this one. I think that you'll do a better job with it. It says, I'm trying to separate my thinking around traditional loans and borrowing. I'm guessing he means, between traditional loans and DeFi loans.
mhm.
Is there a set expectation date to pay back the borrow? Is the idea to pay back with fees generated from pools, etc.?
Okay, good question. So, yeah, what I'm gonna first start off with, I made a video that like dives into like all these different strategies and stuff like that, and like when you might want to pay back and when you might not want to. Over on my second channel, which we're gonna have Mike on pretty soon. I got to get that scheduled for next week. For like just like a little interview. Um, and yeah, I mean it's a little bit of a secret channel right now. We brought on CEO of QuickSwap, or otherwise known as Lunar Digital Assets. QuickSwap's on the front end, but Lunar Digital Assets, they've guided $20 billion in crypto project growth. One of the main reasons why Polygon is where it is today. And, this guy is very, very reputable and spoke with some of the regulatory leaders in the US. So like the SEC chair, literally right before he hopped on this interview. So some great insights over there. But this video will break a lot of that down. In terms of repaying loans and stuff like that, let's open up Aave. So there's no set expectation date. This is a revolving loan. So it's basically a simple process. As long as your collateral is higher than your borrow, then you are good, right? And what's going to happen is over time, this borrow is just going to get bigger and bigger and bigger based on this APY. So today it might be $27,940. Tomorrow it might be a little bit more. It might add $5, $10 to it, right? Just because of the APY, and that's what I'm paying. Now, I can remove collateral still, but I can only remove up to a certain amount until it eventually says, hey, you need to repay that loan before you can remove the rest.
Yeah, because I mean,
So
otherwise you'd get liquidated.
yeah, otherwise you get liquidated. Otherwise, there people would just steal money.
Yeah.
So yeah, that's how that works. You don't have any payments or anything like that. It's just like that loan is going to stack up over time, and you go pay the lump sum. You pay in payments. As far as like if you should pay back with fees generated from pools, the way I like to look at it, Joseph, is like how much are you borrowing against your supplied. In this instance, I'm borrowing 28K against 100K. It's about a 30% loan to value. I'm comfortable with that. I know, hey, ETH would have to go down like at least 50%. Bitcoin would have to go down at least 50% for me to get liquidated. If it goes down 40%, that's where I'm starting to worry. Maybe even 35%, I'll start to worry. But if I'm at a point like right now, I'm not using fees to repay my borrow. The reason why is because if I take fees and I put them back into liquidity pool, if I even take fees and I put them into stablecoin strategy, I can get more than 6%. So if I take my fees and I put them in a stablecoin strategy, earning 15% a year, that's earning me 15%. Whereas if I
As long as
pay,
basically, as long as that money borrowed is outperforming that what you're
correct,
being
correct,
charged to borrow that money,
correct,
there's
exactly.
no reason to necessarily pay it off.
Exactly. Because otherwise, if I go and I pay this here, I'm saving money, yes, but I'm saving 6% a year on say $1,000 compared to earning 15% a year on $1,000. So it makes more
Mm.
sense to be able to, go and just earn more on it. Now,
Now,
obviously the exception is if you're close to liquidation, you should definitely be doing like paying that back that. If you're expecting the market to go down, if you're borrowing too much, there are expectations to that, but or exceptions to that. But yeah.
you definitely need the bottom line. You definitely need to be monitoring your positions.
Yep.
So there's a couple different variables because obviously the APR can change on the borrow. So
Yep.
you need to make sure you keep an eye on that. Especially if you're doing a stable coin, using that borrowed amount for a stable coin play where you're only maybe making 10%, but you're paying 6 or 7%. You're only making a couple of percent. So if one goes up and the other goes down, it might kind of invert, and instead of making you money, it's now costing you money to have that loan out.
Exactly.
So
Yep.
you just really have to, and that's where tracking your the free tracking sheets that we have do great at that,
Yep.
where you really need to track your DeFi positions. The liquidity pool positions right now, you can do in Metrix, and here very soon, Jake was saying at the very beginning, they're going to be adding lending. And
Yep.
so I'm sure that there'll be a lot of that data and a lot of that real time tracking. And once there's that, I mean, you're going to have me hooked for life because if
Yeah.
I can track my liquidity pools and my borrowing and lending all in one platform, it will basically be doing what I'm doing manually in Excel spreadsheets right now. And
Exactly.
it's annoying as shit.
Yep.
About the only thing, and I know it's something you're constantly working on, is there is some protocols that I use that aren't supported,
Yeah.
yet on yours, but they're so obscure. Oh, not obscure, but they're so new. It's to be expected. Like Black Hole, I have one position over on Black Hole,
We're working
open,
on that one, actually.
and I think it's one that you were talking about, wanting to add depending on how well it performed.
Yeah.
But I totally get where you're coming from. If a protocol has very low TVL and it's some obscure chain, and it's kind of like, okay, what's the return on investment? If my pay my programmers to add this to the app, how many people are actually going to use it?
Yeah.
How many people use that protocol? So
Yeah.
no,
Our
this
our our ROI on metrics is about like 2%, I want to say too. And then when it hits
well,
5%, we go bring on another developer, and then we're back to
Well, I
like
mean, it's super affordable. I mean, what you're charging is,
yeah.
not that expensive at all. I think it's like $50 a month or something like that.
Yeah, exactly. It's super affordable to the value it brings you. Like, and just for reference, like, I mean, when we compare that, and I guess it's not exactly like side by side comparable, and it's also not a dish to any groups out there, anything like that. A lot of the DeFi groups are $100 a month, right? Um, so like David's is $100 a month. There's Crypto Labs is $100 a month. DeFi Dojo is $100 a month. Taiki, I think is Taki, or I don't know. I'm sorry if I mispronounced his name, but it's $150 a month. And again, I've not been in there to speak on the value. I know David, since we've been doing the show, is providing an immense amount of value over there. But like I think it's relatively affordable for the actual tooling and the actual implementation that you could get. And we do have $100 a month tier. It's mainly for those that are like, really like making money from liquidity provision, stuff like that, and want even more accurate data, more tracking, stuff like that. And there's some functionality there. But we try to price it affordably. So yeah. And Token Terminal is one of the comparisons. Like they're $50 a month, for tokenomic data. Like we can charge $50 for liquidity pool data. So yeah.
No. I mean, it's, and like I said, I mean, it really depends on, I mean, with the functionality that you just showed us. I mean, I can definitely see where it's going to pay for itself. If you're deploying any real amount of liquidity, into liquidity pools, it's going to make you, this is going to make you that $50 a month.
Yeah.
Because like I said, I mean, just while you were talking, I went in and looked at the different KTA wrapped ETH pools that I could get into. And there was a couple that I could have gotten into that would have made me enough to, pay for a membership for this. So,
yeah,
over what I'm currently making.
Yep.
But Joseph says, wow, so bank loans, car loans, HELOCs will be a thing of the past. And that's why banks are so scared. That's exactly why. I mean, if you've been around for a while, you saw Elizabeth Warren and Gary Gensler, going after Ripple. They were going after crypto in general, and especially DeFi, because yes, I mean, banks are shitting themselves. Mm-hmm. People are like myself are withdrawing their liquidity from banks because I don't make any money there. They do. I can deploy the liquidity. And even if I'm only making, a couple $1,000s a year, that's a couple $1,000s that I wasn't making with it in the bank.
Exactly.
So, and then loans. I mean, where are you going to go to where you get paid to take out a loan? I mean, there is a lot of places, if you do it right in DeFi, that you can get paid to take out a loan.
Yeah.
Because your deposit amount, you have to deposit collateral, and you can make 7, sometimes 10% or more, and then borrowing, depending on what asset you borrow. It's just it's all about just learning how to use these platforms and how to leverage these positions to best suit your investment strategy and your financial goals.
Yeah, and one day maybe we'll be able to start to loop the real estate market on Aave.
Well, yeah, we were talking about the other day. Yeah.
Tokenize our house, borrow against it, buy another house with or a tokenized, buy another tokenized house, borrow against that one, and just we can have 5x leverage in the real estate market. Imagine that, man.
No, I mean that was I think it was either you or David that came up with that. Imagine being able to loop your house.
Yeah, it's a silly idea in theory, but like I could see it from an investment standpoint. Like what if you can, just and again, is it risky? Of course, but like, it's less risky than looping cryptos probably because it's the real estate market. If you have a collateralized real estate investment, let's just say of $100,000, like, and then you borrow, say, 30 grand across it, right? And then you take that 30 grand and you throw it into, whatever you call it, another house that's tokenized. You now have $130,000 exposure, 1.3x leverage. Boom. Like you're going to see a lot more people invest in the real estate market there.
Even outside of looping, I've, personally, I mean, I've looked at, the like up where I'm at, there's a lot of lumber, land and stuff like that. I've actually thought about tokenizing a, bare piece of property that has good lumber. Have somebody, have an assessor come in, look at the lumber and say, okay, there's $30,000, worth of lumber on here, tokenize it, and basically let people purchase it, purchase the tokens to for a return on their investment, and then use that to get another piece of property and just rinse and repeat. There's so many things. I mean, tokenization, RWAs and DeFi are going to open so many opportunities. I cannot stress enough. And I feel like I'm screaming from, a mountaintop to myself sometimes, on this channel and, in chats on different shows and on social media, trying to wake people up to where it's like, why are you sitting on your assets hodling when, I mean, even if you don't want to risk losing exposure to those assets, you can lend those out. You still have full exposure to price appreciation, or you can stake, and the only risks are the platforms that you deploy it on. So as long as you're, doing your due diligence and, looking at the platforms and, some of them even offer insurance, it's like, why would you just sit on your hands and do nothing? Or people that just have money sitting in the bank, and they're what, last year is like 11% inflation, so you lost 11% of the buying power of the money that you had in the bank
Yeah.
because it was just sitting in the bank.
Yeah, exactly. I think might cut out,
Oh
but
yeah, for a
there you
second,
go.
but go ahead.
But yeah, no, what I was gonna say is just like I want to give people a quick walkthrough on if they want to potentially sign up for Metrix. So let me, here we go, share the screen. And as far as the link that you guys are gonna want to use, you're gonna want to make sure you use Mike's link. And then let me take it. I think it's just like with like Mike on the end, but I want to confirm before I okay, I got it. So it's literally metrics.finance/ and a question mark via equals Mike. That's going to get you on Mike's referral link. And then from there,
Which one are you wanting to share?
just the one that I have. Yeah, that one. There you go. Yeah, so you'll go via Mike, and I think he probably has a link in the description or something. Get started today. This will take you right over here. You sign in real quick. If you don't have an account, you still do this. So you just do your email. So mine's jake@metrix.finance. It will send you a little code to your email account. It's just like, this is our login system. It won't log you out a ton of times either, so you don't have to worry about like password or anything. We just found it to be the most secure. So I'm going to go ahead and pull up my email over here. And then after you do that, here we are. That's going to take you right over here. Now, I already have a subscription, but it would prompt you. It would say, enter in your credit card. If you want to do crypto, there is crypto options as well. You just go to pricing, select the tier that you want. We'd recommend getting started on the pro, and then you would be able to select crypto as well. Just right over here, select crypto, takes you over here, and you'll be able to subscribe. Simple as that. And as far as crypto goes, we don't auto bill your crypto account or anything like that. We essentially just have a invoice that we send out every month. As long it reminds you every month through email. It's like pay the invoice, retain access. You pay the invoice, simple connect wallet. It's like trading on Uniswap. That's the beauty of it. So yeah, and then we also have a full breakdown of what you get on different tiers and stuff like that if you are debating it. But anyways, I appreciate you having me, Mike. That's all I have to share for now. And
Absolutely, brother.
be back next week.
No,
Man.
no, I definitely appreciate you coming on because, yeah, I mean, as usual, I mean, I usually learn about as much as I think everybody that watches whenever I have you and David on. So
Yeah, that's the goal.
man, my Starlink just keeps on cutting out.
Got a tree over there. Oh man, you got fully booted. Yeah, Ray. Watch through the recording. Lots to go through.
All right, there we go. So yeah, no, all I was saying is I appreciate you and David coming on because yeah, it's not often that I get to sit back and not have to talk and I can actually learn something.
Yeah.
Because as much as I talk, you would think that I love talking, but I actually do not like talking. I would rather sit back and learn from you guys. So
Fair point.
yeah, I definitely enjoy it. But Hey, Ray, that's the great thing, man. This is recorded. You can just play it back as many times as you need to learn whatever you need to learn. Yep.
Mhm.
So I appreciate everybody in the chat. I appreciate you, Jake, Ray, Papa Steve, Joseph, Stu, Eric, everybody else in the chat. I appreciate you, and anyone watching on X. Next time, jump in the chat because with DeFi, this is your opportunity to ask the questions that you have. You have people at your disposal like Jake. When David's on with us, myself. Of course, you can join our Discord. Down in the description of this episode and on our channel, you can join our Discord. And there is a whole community of people that are happy to help answer your questions.
Mhm.
So, with that, Jake, appreciate you. Until next time, Veteran Crypto out.